We really didn't get much for economic data today, but the data that we did get was encouraging, at least somewhat. This morning, we got 3-year inflation expectations that fall to a series low of 2.3% in July. In fact, as Kevin Gordon says, not only did the New York Fed's measure of 3-year inflation expectations fall to the lowest on record in July, the monthly drop was the largest in the survey's history. Which I will tell you is obviously good news for inflation. Expectations of lower inflation makes it harder for companies, corporations, and individual business owners to pass on cost to consumers. So that is definitely a good sign on the inflation fight. But on the other hand, inflation coming down will actually pressure profitability and margins at corporations, especially if, let's say, producer prices actually go up and companies are not able to pass that cost on to consumers. And actually, for stock market investors like yourself, lower inflation could actually be worse than higher inflation. And it also could be a sign that the consumer is just really slowing down more than we expect. And we'll get more information on this throughout this week, specifically on Thursday, and we'll highlight that here in this video. So on face value, today's drop in 3-year inflation expectations looks like really good news as long as it's not coupled with the consumer, quote, falling out of bed later this week. So I would say today, tentatively, was good news. On the other hand, Apollo says here that with July 2024's data, the probability that the US economy is now in recession is 40%. In fact, the recession may have started as early as March of 2024. Other analysts and big money firms on Wall Street are pointing out today that this is really a consumer discretionary recession, meaning that for products or services you don't necessarily need but you want, that's the area that's really getting hit hard in the economy. And that's clearly true. That's obvious. The question is, does that broaden out to more widespread consumer weakness? And again, that's the big question on investors' minds. Fundstrat and Tom Lee say today that they are watching 3 things this week. At the top of the list is the Middle East conflict. Probabilities favor that the worst is behind us for August. That is, the S&P 500 fell to 5,119 on August 5th, close at 5,344 on August 9th. And this is likely the low for the summer, August through October. So Tom Lee and Fundstrat are basically calling for a sideways to up market at least through now until October. Fundstrat's Tom Lee also says, other than the Volcker era, the market has never been lower in the second half when delivering 10+ returns in the first half, with a median gain in the second half equals 10% with positivity rate of 83% overall. Mark Newton with Fundstrat says reasons to stay bullish in August and buy any weakness for gains into September. As shown below, the SPX has now rallied for 3 of the last 4 trading days. Prices now lie just below the first key area, which also happens to approximate the 50% retracement level of the entire decline from mid-July, shown as a green horizontal line on the chart below. But really, I think this is all noise. I think Tom Lee and Mark Newton, they are fantastic strategists. Mark Newton is the technical strategist. Tom Lee is the head strategist. They are top in their industry, and I give them all respects for that. But let's face it, the only thing that matters right now is economic data. Is the consumer slowing too much? That's what this entire market revolves around, because let's face it, the S&P fell 10%. Yes, it went into a correction just a couple of weeks ago. I called that out on July 9th. 5 days before the markets peaked, I said there was going to be a 10% correction within the next 6 weeks. I was correct. I profited from that. Great. You probably profited from that. Great. But do you know what happened? Nothing. In fact, 2025 earnings expectations did nothing. They're still sitting at the highest they were at when markets were at all-time highs. So in a way, nothing has changed. markets have just gotten a little bit concerned, I guess could be the word, that the consumer could be slowing down. But that has not actually affected earnings estimates from your analyst. And if the consumer does slow down further, and perhaps on Thursday with retail sales, we will get a better indication of that, then that's when you start to see potentially 2025 EPS estimates come down. And that's where you actually get markable downside in markets. So consider this: EPS estimates for next year's earnings for the SPY or S&P 500 is about $279 per share. If we give this a roughly 20.5 times multiple, you're sitting at $5,700 by the end of this year. That's about $40 higher on the SPY. But if there is a larger growth scare and earnings estimates come down to, let's say, 250, which is still going to be higher likely than 2024, so basically like a 2 to 3% gain in earnings for next year instead of the 14-15% gain that we're currently expecting, and you give this a 20.5 times multiple, then you're at 5,125. That would be downside on the SPY of about $20, give or take, from here. Not a big deal. But if that multiple does compress, let's say down to 19, then you're looking at a market that's substantially lower potentially than where we are now at 47.50. So I think there is that risk of, one, multiple compression if we do get more recessionary signs, and also EPS estimates that could fall. So if you want to put pad to paper, if you will, that is the risk in equities today. And that's where I just get a little bit nervous, because if the fears grow in markets and estimates do start to come down, there could be some material downside from here in equities. Good news is we don't have to wait too long to get an answer to these questions. Retail sales come out for Thursday. This is a month-over-month number. That's the one that the markets really pay attention to. For the month of June, we came in at 0% for retail sales month over month. We are expecting a positive 0.3% number. So that would actually be growth in retail sales on a month-over-month basis. The potential risk is that retail sales come in negative and then you're actually declining month over month. And that's where the markets would start to maybe say, hey, is this going to be just a discretionary recession, or does this turn into something that is more broad-based? Now, with that said, if we come in line with estimates of 0.3% and there's actually growth to retail sales, then I think a lot of this consumer fear, at least in the near term, is going to go away. Like just like that. Especially if we get a strong retail sales number, I could see a pretty vicious rally in markets. I also think the odds of a 50 basis point rate cut from the Fed would fall, and that would actually be good news for markets, because the last thing you want is the Fed that needs to cut rates just, 50 basis points, 75, 50 basis points, some large, rate cuts to bail out the economy. That's never going to be good for stocks if you get large rate cuts from the Fed. Now, if the Fed is able to just maybe every meeting do 25 basis points until they get to something that is more neutral, that's the better case scenario in regards to the Fed cutting rates and what equities will do. So I do think it is a little premature to say the summer lows are in at this point, because it comes down to the economic data. But good news is markets have bounced quite a bit from that 510 low up to where we are today. You've bounced about 4.5%. That does give us a little bit more cushion, but I do think Thursday could easily be a 2 to 3% down or up day for that matter, depending on retail sales. With that said, the markets are currently pricing in a 25 basis point rate cut. The odds of that are 56%. The odds of a 50 basis point rate cut were as high as 85% at one point for September 18th. Now they're only 44%. So Thursday is really going to move these odds a lot. Thus, I'm expecting there will be a lot of volatility around the 10-year treasury as well on Thursday. 10-year treasury yields today are actually down about 4 basis points to 3.90%. But part of that is probably the Middle East conflict. It was reported about 6 hours ago that the US is going to send carriers and missile submarines to the Middle East. This was reported via the Wall Street Journal. And then it was reported a couple of hours ago that Iran could attack Israel in less than 24 hours, sources say, as Western powers issue Tehran a warning, according to Fox News. And U.S. Treasury bonds are seen as the safest asset in the world. So when there is these fear events, you normally see investors go buy the Treasury. Especially when rates are as high as they are, the Fed's about to start cutting rates soon. It makes sense why investors are going out and buying TLT on a day like today before this apparent Iranian attack. You could see TLT is up 0.5% today. And when people go out and buy the bonds, it's like people going out and buying a dividend stock. The yield falls as more people buy it. So today, you're really seeing a little bit of a flight to safety. Gold also did well today, and oil also did well today. These are direct correlations to this Middle East situation. But really, as I've explained before, I think anything that does not have a economic implication to the US will be short-lived in nature. Iran has no economic impact to the US. They have an economic impact to oil, but so does Russia. That really didn't affect anything in 2022. Markets freaked out for a couple of days via the Russia-Ukraine conflict, but then everyone said, yeah, it's all about the Fed. It's all about the economy and a potential recession again. 2022 was not categorized by Russia invading Ukraine from a market perspective. And I think Israel-Iran conflict would be another one of those short-term situations. Even if you look at Israel and the impact Israel has on our economy, it is minimal at best. But not all geopolitical conflicts are going to be small in nature. Let's say one day China is threatening to invade Taiwan, for an example. That would have a much larger impact. That would be a black swan event. That would be very, very bad because of our relationship with Taiwan, the economics that we have via that country, especially with semiconductors, for an example. So geopolitical tensions, it just depends where it is, what kind of impact it has on our economy. And these Middle East situations have very little, if not zero, impact on our economy, as long as there's no boots on the ground U.S. involvement or threats of all-out, World War III or something along those lines. Then this will just be contained to a short-term fear event, and well, that's pretty much it. So in fact, I'm not worried about this from the market's perspective at all. But yes, it could cause short-term downside. U.S. Defense Department spokesman Kirby says we have to be prepared for what could be significant attacks. What's more concerning is U.S. Chapter 11 bankruptcies are soaring, with total filings up 34% year over year in the first half of 2024. Small business filings up 61% year over year, and June saw the highest corporate bankruptcies since 2020. And if you look at the chart, yeah, you're definitely starting to move higher. You're at the highest level for corporate bankruptcies that you have seen at least since 2011. So with all of this bad news out there, consumers slowing down, corporate bankruptcies rising, is this really going to have just a minimal impact on the economy? I'm not confident enough to say that. And again, that's why the consumer is so important right now to investors. And as you can see from James E. Thorne on X, U.S. inflation scare is over. This is Harmonized Index of Consumer Prices. This is all items for the United States. After hitting over 10% briefly in 2022 and early 2023, now you're back to 2%. I mean, inflation is over at this point. And that's why I do think inflation data coming out this week with CPI and tomorrow's PPI report is not nearly as important as Wednesday's retail sales numbers, but there can still be some volatility around these inflation reports, especially if they come in higher than expected. That would be the worst case scenario. Dan Ives writes on X, NVIDIA earnings on August 28th. You will be able to hear a pin drop on trading desks around the street and globe as investors hear from the godfather of AI, Jensen, on the massive demand trajectory for AI chips into 2025, which we believe will be another drop the mic moment for tech. Dan Ives is one of the top analysts in the world. He works with Wedbush Securities. Frederick on X says, continue to follow the 2009 through 2013 analog. Right back to trend with ongoing 2024 SPX pullback. Analog still informs / tracks of high probability to achieve 5,800 by year end. But that really only happens as long as the consumer starts to show some strength here. So if you're betting on a market that's higher from now into year end, you're really betting on the consumer that does okay. I do find this very encouraging from Mike Zaccardi on X. He says 42% of CEOs expected conditions in their own industry to improve over the next 6 months, up from 38%. And most US CEOs no longer anticipate a recession in the coming year. You can see this is from 2023 of Q3 versus 2024 of Q3. 80% of CEOs expected a brief and shallow US recession with limited global spillover. 80%, the vast majority of CEOs back a year ago. Now only 29% of CEOs expect a brief and shallow US recession. 4% of CEOs 1 year ago expected a deep US recession with material global spillover. Now that's 1%. That's a 75% drop. That's high. That's quite remarkable. Now, 17% of CEOs back in 2023 expected no recession. Okay. Now, 70% of CEOs expect no recession. That is a pretty dang good sign. Now, perhaps that's because CEOs have kind of realized if you talk doom and gloomy on conference calls, your stock gets reflective of that, right? So there is some of this, we don't want to scare the markets mentality, I do believe, going on. But organically, there probably is more CEOs that are optimistic now compared to 2023. Then again, as Market Radar responds to this and says recessions don't happen when everyone expects them, we saw that in 2022, and that's also true. Recessions tend to happen when nobody's expecting them, or at least when the consensus view is not that we're going into recession. Seth Golden writes on X, there's not much lending upward mobility in core CPI month over month or year over year. If Pantheon's Ian Shepherdson's forecast proves precedent, inflation fight is over. Increased likelihood of more rapid rate cuts or pull forward of the easing cycle. You can see Pantheon's estimate for July CPI month over month for core is coming in at 0.16%. Prior estimates were 0.07%, and what you seen in May was 0.16%. So overall, he's been pretty accurate. And if he's accurate for this Wednesday's CPI report yet again, could raise the odds of faster cuts from the Fed, or at least potentially lower the odds of what the markets might deem an inflation-induced recession. Mark Newton with Fundstrat also says here, did the market already bottom in August? Lots of data suggest, although not the technicals just yet. Technicals are lagging discipline. Most market troughs occur in August, especially during election years via Fundstrat. So about 44% of the time markets bottom in August during election years. But it's pretty close as well for October, with 40% of the time markets bottoming in August. And during election years since 1990, I mean, you're at 44% for August and 44% for October. It drops down to 33% during election years, for October being the bottom, and 46% during election years for August being the bottom. So Yes, this is kind of leaning towards August could have been the bottom. But again, I think this year is a lot different than other years, being we're just concerned. We don't know what's happening with growth, with the consumer, and ultimately what's going to happen with the economy. I don't think this year can be categorized as election volatility or uncertainty. This is really starting to look like a growth scare. Whether or not that's just a scare or actual reality will be what drives the markets higher into and after the election. Nick Timmerhouse, widely seen as the Fed's mouthpiece, reiterates on X, Goldman Sachs, where Goldman says 70% of the rise in the July unemployment rate came from temporary layoffs, but state-level data don't show any big jumps in Texas unemployment. What you'd expect if Hurricane Beryl did this. Among states, California had the largest rise. Among industries, leisure and hospitality. So what Tom Lee and other Wall Street experts have tried to say is Hurricane Beryl really caused last month's unemployment rate to rise, that and more labor supply and a higher participation rate. But what Goldman is saying is that's not reflected in any of the data. Goldman also says we're tracking Q2 GDP growth at 2.5% and Q3 at 2.6%. Solid final demand growth is one reason why we expect demand for workers to hold up and prevent significant further deterioration in the labor market. Seth Golden says he's not expecting much in the way of monthly retail sales when released this week. High-frequency Red Book retail provided below trend in July, with ample enough service providers speaking to cost-conscious consumers rising. Notes from Wells Fargo is attached, and you're not really seeing much deterioration or really much strength relative to kind of what we've seen over the past 2 years. It's kind of going to be a so-so retail sales report. But again, is that report negative? Is it better than consensus? That's what is going to drive the markets for probably the next week. Here on the day today, the Fear and Greed Index from CNN is still in extreme fear territory at 24, with market momentum in fear, stock price strength in fear, stock price breadth, extreme fear, put and call options, extreme fear, market volatility, neutral, safe haven demand, extreme fear, and junk bond demand in extreme fear. The percent of stocks currently trading above their 50-day moving average is not looking so hot today, down to 41.43%. You have about 3.2% of all stocks falling below their 50-day moving averages. So today's actually a pretty rough day for markets under the surface. Most of the outperformance today is really happening in the land of big tech. Apple is up 0.6%, but it's really Nvidia that is up about 5% today, and Amazon and Microsoft up 1/3 apiece. That's really driving the SPY today. And yeah, without Nvidia being up 5%, it would be a much worse day out there. Now, from a technical perspective on the SPY ETF for the S&P 500, I'm expecting if we get good retail sales, a retest of this 50-day moving average to the upside would be in play. That would be upside of about $10 from here. That would be a potential gain from prices we're currently at of about 2%. That's my expectation. If we get a worse than expected retail sales, you could fall as low as $5.20, which is about a $12-13 move to the downside. If you fell under that, I think that's a little extreme for just one data point. That is a potential move lower of 2.2%. But we've seen a lot of volatility recently. It wouldn't surprise me. I wouldn't be shocked to see us fall lower than that. But I am expecting, give or take, a 2% move coming on Thursday if the data comes in really good or really bad. But really at this point, if you're an equity investor, trader in the short term, that's the only thing that matters. Israel, Iran conflict, that could add some pressure to the downside, but I don't think it's going to make or break our week by any of this stretch of the imagination. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you made it to the end of this video. You might as well tune in here once daily and stay more up to date on what's going on in our markets and hopefully help you make more money. Nonetheless, enjoy your day, and I will see you in the next one.